Okay, so we talked about the four quadrants, and now whenever I draw this, you're just gonna know that I'm talking about the four quadrants. What was the first one? Employees, self-employed, business owner, investor. Four quadrants of making wealth. The way that these four quadrants work, and the tax system especially, is very different. It depends on the country that you live in. Even in the United States, it depends on the state that you live in. But let's pick, for example, the United States. If you make money as an employee, depending on how much money you make, anywhere from 0 to, I would argue, 40%, the federal government would take it. Depending on the state that you live, anywhere from 0 to, let's say, all the way up to 15%, the state would take it. Which means if you make money as employees, you can pay up to 55, sometimes even more, because you may have to pay 7.5% on Social Security and Medicare and other things. So you may end up paying about, depending on how much money you make, up to maybe 60 to 65% of your money. The federal and the state and the Social Security and other people will take that. It's a very, very heavy cost of making money as an employee. If you don't make that much money as an employee, maybe you don't get taxed that much, but higher than you make money, and depending on the state you live, it's going to be taxed differently. California, at the time that I'm creating this video, California has a state income tax of 13%, around there. New York has a high state income tax. Washington has a 0% state income tax. Nevada has a 0% state income tax. So depending on where you live, right, the tax systems are very different. So anyway, 60 to 65%. And this is so high. When I first started my own, when I started my company and one of them became successful finally after years, I was surprised on how much taxes I had to pay. I felt like more than two-thirds of my money was going into taxes because I also was filing late. I didn't know I had to pay these taxes up front. So I was paying a penalty on top of the 60 to 65%. Oh, it was very, very painful. But you gotta pay the taxes. What can you do? When you are self-employed, some expenses that you spent on the business is tax deductible. Which means any money that you spent on those, you don't have to pay any taxes. You pay zero taxes on the expenses that are business related. It's really nice. So then after those expenses are deducted, then the rest is what you pay the taxes. Right? You still have to pay probably something similar to this, but at least if you spent, let's say, half of that money that you made into the business, or you had like business meals, legitimate business expenses, then the government will give you 0% tax, which basically means anything that you buy that can be used for the business is almost as if you're buying it for 60 to 65% discount. Isn't that wonderful? So there are benefits of becoming a self-employed person. You can have a lot of tax savings from that. If you own a business, again, depending on how you structured it as an LLC or as a C Corp or as a S Corporation, but if you did it as a C Corporation where it's going to be taxed by itself, just know that roughly 20 to 25% of that is going to be taxed. And then, the money gets left in the bank, right? After paying about 20 to 25% tax. That may go up and down depending on the administration. Whatever is left, if you want to then pass it back to yourself, there may be another tax. Usually, if it is a C Corp, if it is an S Corp, there is no 20 to 25% tax. All of that just get passed through directly to you. But if it is a business, and we're going to talk about more as a C Corp setup, then that money, after you pay tax, it sits in the business bank. If you want to pull money out from your business bank into your personal bank, then you may need to pay additional taxes, but let's not worry about that. But that's what often business people call double taxation. But if you leave the money in the business, which I think you should do, then you pay 20 to 25%. Isn't that crazy that business pays a lot less in taxes? And plus, any expenses that are business related, just like the self-employed, they don't pay any taxes. It's fully deducted. Wonderful, right? So not only you get to reap this benefit, but you also pay less taxes. So tax-wise, what is the most efficient? Well, let me introduce the investors. Investors, depending on how do they do things and whether it's a short term. So if you own something, right, for less than a year, usually that's called short term or ordinary income tax. Ordinary income tax. And that could be a little bit high, but not high like 60 to 65%, right? But it could be high. But if you owned it for more than a year, it would be treated in what's called a capital gain. And that is about 20%. Now, all of this depends on the country. But what you will see is, okay, just based on what I talked about, what is the worst quadrant to be in terms of the tax? Being unemployed, the E bucket is, let's say, number 4, right? It's the least favorable in terms of the tax. What's the next? What's something that's better than that? This one, self-employed. Maybe you have your own business. You become a freelancer. And you work for other companies, but you own your business and you're a freelancer. At least you can deduct business expenses. So any miles that you drive on the car for work, or you had business lunch, or you paid for the office, or you bought some books because you want to educate yourself, you went to some trainings, any of those legitimate business expenses, you pay 0% tax. So that's better, right? What's the next best thing? Business owner. It's really neat, right? And I would say even short investor and business owner, they're really tied in really well. They're pretty comparable. So isn't it also interesting why Robert Kiyosaki also called it the right side of the quadrant? If you're on the right side of the quadrant, the BNI quadrant, you're in a good place, right? Tax-wise. And if you think about it, it makes sense because the people that created these laws and the tax system, they are most likely business owners and investors. So of course they made it so that it's more favorable for them. I think that's part of it. Maybe there are other reasons to it. But again, employees, it's going to be hard for you to save a lot of money and to build that financial wealth of circle of wealth, because government's going to take a lot of that, right? There are some tactics you can do so that you can defer some taxes by putting into some other tax deferred strategy. But, again, that's why I think it's better for the employees to start playing with some of the investor bucket, own real estate, and then start making money every month from that. And if you owned it for more than a year, when you sell it, you only pay 20% or about that, not 60 to 65%, right? So it's a much more efficient way of gaining your assets and gaining wealth.